Hi everyone, welcome back to Anu's classroom. In this video also, we'll be continuing with all the important question answer discussion based on the previous year's question paper. Okay, so as we all know, MMPC for Accounting for Managers, it is a problem paper. It has practical as well as theory. Not practical actually, mathematical questions as well as theory. So out of whatever pattern we are having so far, at least one or two questions there will be for like prepare the trial balance or balance sheet or something like that. Some questions will come and then the rest of them will be theory based. So for people who are not from the commerce background, from the non-commerce background or even arts or technical backgrounds who have come to do MBA, for them, grasping the concepts of how trial balance is prepared or balance sheet or cash flows prepared with all the different types of discountings and adjustments and all those things combined will it will be a bit difficult. Okay, so for you guys the best strategy would be to concentrate on the theory concepts, theory part of it, and write down as much as possible, because we'll have at least 8 questions. From that we only need to attempt any 5. So if you, even though you do not know how to practically prepare these financial statements from a given set of transactions, it is fine. Do not fret about it. Do not be scared because you don't know how to do that. You will flunk in the exam and all. Absolutely, it is not the case. With good sound theory knowledge also, you will be able to ace the exam easily. Okay, so we already covered a few questions in the last video. So we'll be covering few more in this video. Okay, so let's get started. So the first question in this video is, describe the drawbacks of traditional budgeting techniques. And the question goes again to ask us to explain the concepts of performance budgeting and zero-based budgeting and discuss the applications of these techniques. And another term and examination paper, we had a similar question which went like this: zero-based budgeting provides a solution for overcoming the limitations of traditional budget. Explain the statement and describe the procedure to be adopted for preparing a zero-based budget. Also explain its advantages. Okay. So for this, what we need to know is, first and foremost, what is traditional budgeting? So traditional budgeting is one of the methods that are used to prepare the budget of the company for a specific period under consideration. Okay. Where budget of the previous year is considered as the base. Okay. That is traditional budgeting. So last year's budget is considered as the base using which budget for current year is prepared. So we'll take up the last year's budget and we'll add whatever inflation or what are different aspects are there, monetary aspects are there, inflation or depreciation, whatever it is there, we add it and then we create the new budget. Very easy, very simple, the simplest form of budgeting. Now, what is budget? We had discussed it in the previous video. It is a way to balance the income and expense and meet the financial goals for a specified length of time. That is budget, right? So traditional budgeting, it uses the last year's budget as a base to make this year's budget. So it is a method that actually depends on the same year's spending to do the budgeting for the current year, right? So the only benefit of going for this sort of budgeting is actually the simplicity. Why? Because if the company is following this type of budgeting, it does not need to rethink every item on the list at all. Instead, they can just look at the previous spending and then they can add or deduct the inflation rate or the market situation, customer demand, etc., and get with the new budget for this year. Right? So most people as well as companies, they prefer this type of budgeting because they can sit with whatever data they have with them and they can create a budget very quickly. It doesn't take much time. Naturally, there are drawbacks. It is costly, it is time consuming, there is lack of flexibility. The traditional budgeting process is actually very much centralized process, and there is no link between what is the actual business strategy and what is the business budget. Okay, so that is traditional budgeting. Now, and the drawbacks of traditional budgeting. So now, what is performance budgeting? Performance budgeting is is a budget that reflects both the input resources. Okay, it what you can say, yeah, it reflects both the input resources as well as the output services. Okay, output services of each unit of the organization. So the goal is actually to identify and score the relative performance based on goal attainment for specified outcomes. Okay, so this type of budget is actually commonly used by government bodies or agencies like that to show the link between whatever the fund the taxpayer is providing or and the outcome of the services that are provided by our governments, maybe the federal government or the state government or local government, whatever it is. So that is performance performance budgeting. Okay. Next comes the zero-based budgeting. So zero-based budgeting is another budgeting technique in which all the expenses must be justified for a new period or year starting from zero. So zero is the base. So starting of every year, the budget is, like you can say, it starts from zero. Okay, versus starting with previous budget and adjusting as needed. So the zero-based budgeting is actually a very highly effective business planning tool to help the company identify and eliminate all the unnecessary cost and keep a control on the spending and focus on actually very high performance initiatives. Like we said, right, in traditional budgeting, companies, they start with previous year's budget as a template and then build upon it, right? But in zero based budgeting, the base from which the company starts to build up its budget is actually from zero at the start of every budgeting period. Okay, so usually in traditional budgeting, each new budget will increase incrementally compared to the previous period's budget, and companies just need to justify the why they have a new expense. So it could be because what you can say, it could be because the customer demand is more, or because there is inflation is high or something like that. So whatever is the extra expense that is coming up, they just need to justify that. Whereas in zero based budgeting, what happens is that, as we said, right, it is starting with zero base. Every new budgeting year, it starts from zero. So whatever expenses are there, it must be justified before adding it to the new budget. Even the old expenses, from whatever expense we had last year also, before adding to our new budget, we should again re-evaluate it and justify it. Okay, so the major advantage is that the budget is very much flexible and it is focused on operations and lowering of cost. It is much more a disciplined approach, you can say, disciplined execution. But again, the disadvantage is there, that is, there is a possibility of it being resource intensive, because every year we have to re-evaluate and re-evaluate stuff which actually may not even be changing. Okay, so being manipulated by savvy managers, and there might be a bias towards actually short-term planning as well. Okay, because we are starting with zero, so every year there is a possibility that we can tweak some way or the other and justify it and get done with, get it, go with, and you can say additional budget. So the last part of it is actually the procedure to be adopted for preparing the zero based budget. Okay, so there are actually 5 steps for preparation of the zero based budgeting. Okay, businesses can develop or modify their own unique approaches to zero based budgeting as well. But generally there is this 5 step process that business firms, what you can say, follow. Okay, so at first, again, we start from ground zero up, right? We begin at ground zero and we create the new annual budget from scratch without using last year's actuals as baseline. Then the next step comes as, so the first step is start from zero, the next step is evaluate. So we have to evaluate every cost area and eliminate or reduce unnecessary activities or services. Then after evaluating, we must justify what, the all the components of the budget. We have to identify cost effective and relevant and cost saving areas, right? And then the next step is streamlining, that is, determine what activities could be performed and how, automate and standardize the processes wherever possible. So we have to entirely streamline the process. And then the next is we have to execute. So that is, roll out the comprehensive planning and execution process and communicate all the clear plans and roles and responsibilities to all the stakeholders. So that is the 5-step process involved in zero-based accounting. I will make it short as ZBB. Alright, so the next question is, what is ratio analysis? Describe the various profitability and liquidity ratios, explain the significance of each of these ratios, and discuss how these ratios are interpreted. Okay, so what is ratio analysis? So ratio analysis can be thought of as the study or the analysis of all the line items that are present in the financial statements of the company. Okay, so it can be used to check various factors of a business such as profitability, liquidity, solvency, and efficiency of the company or the business. So this liquidity ratio, it actually measures how well a company can pay its bills. Okay, So liquidity ratio measures how well a company can pay its bills actually. So you can think of it as how good is the liquidity of that company. Like if in case there is a need, how easily can they liquidate their assets into cash. That is what is being checked for in the liquidity ratio. Whereas profitability ratio, it actually examines how much how much profit a company has earned versus the expenses it has incurred. Okay, so profitability ratio is actually a profit versus expense ratio. Okay, so both these ratios actually allow the business's management as well as the creditors and investors and all to examine the financial health of this company as well as the potential profitability potential of this company. So liquidity ratio, you can think of it as a formula that measures a company's ability to pay the bills or make payroll by comparing the liabilities or expenses and outstanding debts or debts that will be incurred in the near future to a company's assets. Okay, so it is intended actually to measure the company's cash on hand. So assets should be measured in cash or in a form that can be easily converted into cash. In fact, the liquidity ratio, you can think of it as sometimes actually referred to as cash ratio as well. Okay, so if instead of liquidity ratio, if they are asking you about cash ratio also, you should write the same thing that you are writing for liquidity ratio, because it is another name for liquidity ratio. Okay, so it is used to measure the company's cash or cash equivalents against all the liabilities. Okay, so this ratio actually measures just how much cash will be likely in hand at any given point of time. So some of the few different liquidity ratios are like, for example, we have quick ratio, then we have current ratio, then we have day sales ratio. So all these things are different types of liquidity ratio. Okay, then what next is the profitability ratio. As we said, it reflects the company's ability to generate revenue and earnings compared to incurring all the cost or losses over a period of time. Okay, so it measures actually the profit and versus the expenses. So this report is again used by investors and creditors to decide on whether or not they should invest or provide credit to this particular company. Stockholders can also look at this ratio because dividends and all produce revenue for them, and changes in profit will actually affect the amount of dividend that they could expect from the company, right? So some of the few different types of profitability ratios again you could think of as return on assets, that is ROA, return on equity, then we have return on invested capital, and return on capital employed. So these are the few different ratios of profitability. Now, the next question is, discuss the major developments that have led to increasing focus on human resource function of accountability. It is also asking us to explain the cost-based methods of this human resource accounting. Okay. So we should start by saying what actually is human resource accountability or human resource accounting, right? Human resource accounting, or HRA, okay, HRA in short, it is the measure of the cost and value of people to the organization. It involves the measuring costs that are incurred by organizations to recruit, select, hire, train and develop its human resources, that is employees, as well as judge their economic value to the organization. Okay, so it actually involves measuring the data of human resources, all the costs that are incurred in or involved in recruiting and maintaining them, and what all are the returns that we can achieve from them. Okay, so human resource accounting is actually how much you are having to spend, the cost to company versus the what you can say the benefit to company from human resources. So this cost-based method of human resource accounting actually is, there are several methods. Generally, we can what you can say, think of them as generally four to five what you can say methods. Okay, so the first one is the historical cost method. Then we have the replacement cost method. We also have the present value method, economic value method, and we have asset multiplier method. Okay, so we are being asked to explain just the cost based method. So that is two methods are there: historical cost as well as replacement cost. So this cost method, actually the cost approach, it involves the computation of all the cost of human resource to the organization, right? So the cost is actually capitalized and amortized over the useful life of the asset. Cost is actually what, in this case, cost is actually the sacrifice that has to be incurred by the organization to obtain some kind of an anticipated benefit or service. So you might have heard the term that by the time you reach around 15 to 20 years of experience, the cost incurred to maintain you by the company will be high, and therefore company you are at a higher risk of termination than freshers who don't need whom the company does not need to pay much, and the output from them is much more compared to like a 15 or 20 years experienced person, right? So this is the thing. They by the time you are 15 or 20 years of age, you would have not age, years of experience, you might have hit your 45 or 50 years of age around. Okay, so your attitude towards life itself would have changed. You might have become much more mature, and your ability to adapt to changing situations also would have come a little bit down. Your risk aversion would have become much more. You would have a lot of other responsibilities outside of work that you will have to fulfill. So a lot of things would be going on compared to a fresh college graduate who just wants to explore the world and learn a lot, right? Compared to them, your responsibilities are more, so your obligations are more, therefore you will need to be paid more. And also you would have naturally started to slow down after all the hectic work you've been doing from the time you entered the industry as a fresher, right? So, or it's almost like, the juice is all you have, the companies would have extracted the maximum juice out of you. Now there won't be much juice left in you, so the cost incurred to keep you or maintain you becomes much more than the output that you might be able to bring in for the company, right? So that is like, if right now it is the capital, human asset, all these things, that fancy terms we are giving for human resources, right? But the hard fact is, from the companies, from the business perspective, you are reaching the end of the useful life for the company. So what will the company do? You are just another asset or capital. Okay, you will be replaced. The company, that's what we say, right? Don't love your company, because the company will never love you, and it will stop loving you the moment it realizes that you are no longer of worth to it. So what will happen? You will be replaced. So then the replacement cost will be incurred, right? So what is historical cost and replacement cost? Let us look a little bit in detail. So this historical cost approach, in this approach, the actual cost incurred on recruiting, hiring, training and development of the human resources of the organization are capitalized and amortized over the expected useful life of the human resources. Okay, then we have replacement cost approach. In that, human resource of the organization are to be valued on the assumption that a new or similar organization has to be created from scratch, and what would be the cost to the firm if the existing resource were required to be replaced with other persons of equivalent talent and experience. That is replacement cost approach. Then we also have a cost approach called opportunity cost. Okay, so cost based method, we have historical cost, replacement cost, as well as opportunity cost, which I forgot to mention earlier. So opportunity cost is the value of the asset when there is an alternative use to it. Okay, there is no opportunity cost for those employees that are not scarce, and those who are at the top also will not be available for auction, like the COO, CEO, CFO. There is no question of replacing them. Okay, so as such, what will happen is that scarce people only will be valued by the company. Like for example, if your skill is a very niche skill, there is not many people who know this, at least at your expertise level, companies will think twice before letting you go. But if there are a lot many people in the market, then the cost of replacing you, or the opportunity cost in keeping you, is not that great. So happily the companies will let go of you. Okay, so that is opportunity cost. Okay, so the next question is actually a two-part question. This first is to discuss about Altman's z-score, and the second is DuPont analysis. Okay, so let us look at what is Altman's z-score. So this Altman's z-score model is actually a numerical measurement that is used to predict the chances that a business is going to get bankrupted in the next 2 years. Okay, so this model was actually developed by an American professor called Edward Altman in 1968. Okay, so that is why the name is Altman's Z-score. Okay, as a measure of financial stability for companies. So Altman's Z-score is a measure of financial stability of a business. This Altman Z-score model is considered actually very effective method for predicting the state of financial distress of any organization by using multiple balance sheet values and corporate income. So Altman's idea of developing a formula for predicting this bankruptcy actually started at the time of Great Depression, when businesses experienced a very sharp rise in incidences of defaults. Okay, so that is Altman's Z-score. Next comes the DuPont analysis. So DuPont analysis is again a framework that is used for analyzing the fundamental performance of a business. And it was originally popularized by DuPont Corporation, and therefore it is known as DuPont analysis. Okay, it is widely used to compare the operational efficiency of two similar firms. So it is actually very useful technique to what you can say, decompose the different drivers of the return on equity, or return on equity. And there are actually two different what you can say, two different versions of how we can do this DuPont analysis. One has only 3 steps, whereas the other has 5 steps. Whatever be the number of steps, okay, 3 or 5 step equation, what happens is that by doing this DuPont analysis, we get a deeper understanding of the company's return on equity by examining what is changing in a company rather than looking at some simple ratio. So as always with any financial statements ratio, they should be examined against the company's history as well as its competitors. Like for example, when we are looking at two peer companies, okay, what example, maybe Tata Sky and Airtel Dish TV. Okay, so one of them may have a lower return on equity, okay, one might have a little bit higher. So with this 5-step equation, we can see whether this one with lower return on equity, why it is lower. Is it because creditors perceive the company as risky and it is charging higher interest, or if the company is actually poorly managed and it has to leverage and has the leverage is also very low, or the company has very high cost that is decreasing its operating profit margin. So identifying sources like these actually will lead to a better knowledge of the company as well as how we can value it. So the DuPont analysis actually is a measure of the value of the business firm. Okay, so that was Altman Z-score and DuPont analysis. Next question is, what do you understand by operating and financial leverages? Explain how is financial leverage one of the important considerations in planning the capital structure of a company. Explain with an example. Okay. So what is this financial leverage? Okay, we are asked to understand what we mean by operating and financial leverage. So let us look at that first. So financial leverage is actually a metric that shows how much a company uses debt, okay, to finance its operation. That is how much a company uses loans or such debt instruments to actually bring in money to the company to fund its operations. A company with a very high leverage, a high level of leverage needs profits and revenue that are high enough to compensate for this additional debt. Okay, it shows on its balance sheet, right? So if you are running your business by taking loans from other banks and stuff, then you need to generate that much profit in your business, then only you will be able to repay them and still make a profit, right? So it is the same thing here. So investors who look at the company's leverage, it is because it can be an indicator of the solvency of the company. Also, the debt can help magnify earnings and earnings per share as well. However, there is a cost associated with leverage in the form of the interest expense, right? When a company's revenue and profits are on a rise, you can think of it as leverage works well for the company, okay, as well as investors. But if the revenue or profit is pressured or it is falling, then the debt and the interest expense must still be paid, right? And can become a problematic thing, because if there is not enough revenue to meet the debt and operational obligations, then definitely it will go for all the solvency and seizures and all those things, correct? So that was financial leverage. Now, what is operating leverage? Operating leverage is an indication of how the company's cost is structured. So it is a metric that is used to determine the company's break-even point. Okay, break-even point, which is where the revenue from sales covers both the fixed and variable costs of production. Whereas the financial leverage, it actually referred to the amount of debt that is used to finance the operations of the company. So coming to how we can use this financial leverage while planning for the capital structure of the company, first and foremost, we need to understand how the capital structure of a company is established. Okay, so a lot of quantitative as well as qualitative factors have to be considered when we are trying to establish the company's capital structure, right? So first, from a sales standpoint, when we are considering the company that exhibits a very high and relatively stable sales activity will definitely be in a better position to utilize this financial leverage, right? That is taking more cash flow in the form of debts compared to a company that has lower or more volatile sales. Secondly, when you think about it in terms of business risk, so when we are talking about how financial leverage is a consideration in planning capital structure, first we are thinking about is from the sales perspective. Okay, next is we are thinking from the business risk perspective. So a company with less operating leverage will tend to be able to take on more financial leverage than a company with a very high degree of operating leverage, right? Next is the third thing we have to consider is in terms of growth. So naturally, companies that are very growing very fast, it will likely to be relying more on the financial leverage usage because they tend to need more capital at their disposal than slow growth counterparts, right? Then fourth is from the standpoint of taxes. So a company that is in a higher tax bracket will tend to utilize more debt to take advantage of the interest in tax shield benefits, right? So even for us, right, when you think about it, the income tax structure also, like below, I think around 2 or 3 lakhs, we don't have to pay any tax. Up till 5 lakhs it is something else, up till 10 lakhs it is different, 15 lakhs is different, 20 lakhs is different, the tax bracket increases. So you might have seen salaried people, what they will do, they will invest in policies like ATC and ATD and all those things, or they will take loans and they will take maybe housing loans or vehicle loans and all such things to leverage on the tax benefits, right? So because if we are paying so and so amount for tax, then based on that the taxable income will reduce, right? So this is the same thing. So if a company is according to their profit margins and all, if they are falling in a higher tax bracket, in order to not give as much taxes, what they will do is they will focus on taking more debts. That is the financial leverage. In the same way, if it is a very less profitable company, then it will also again try to use more financial leverage because this company, if it is not as much profitable, then it is not in a strong enough position to finance its own business operations from the internally generated funds. So again, they will try to rely on the external funds, that is through financial leverage. So this capital structure decision, you can see that it can also be addressed by looking at a host of a lot of internal as well as external factors as well, like from the standpoint of management. If the company is run by aggressive leaders who tend to use more financial leverage, then again we will be looking at heavily relying on this financial leverage. So all these things, then again, if the company is going through good times also, maybe they want to raise more capital, then also they will look for financial leverage. If the company is going in bad times, then suppliers capital, all the suppliers also will need to be repaid. So again, what will happen is that we will take debts, that is financial leverages, to pay off their creditors and all those things. Okay, so So that is how financial leverage is an important consideration while planning the capital structure. So based on that, maybe you can give an example of say company A and company B, a fictional example you can make up and write. Okay, so company A may be going in a fast paced growth, they want to expand, so they are doing financial leverage. And maybe company B is not in a good state, they are having losses upon losses, they have to pay back their shareholders and stuff, so then they are relying on financial leverage. So something like that, you can each consideration, each of these, like sales perspective or risk perspective, growth tax perspective and all, you can make up examples and give. Okay, so the next is what is activity based costing. Explain the main features, objectives, merits, demerits. Describe the process for implementation of activity based costing. So this activity based costing is actually a method for assigning the overhead as well as indirect cost, right, such as salaries, utilities and all, to the products and services that are generated by the company. So it is actually a system of cost accounting which is based on activities, right? It is based on activities which are considered as any event or unit or work or a task with a specific goal. So in detail, I have uploaded a video for activity based costing, which explains all the main features, objectives, merits, all these things I have explained in detail. Okay, so I'm not going into it once again over here. I will leave a link to that video in this. Okay, go check that video out to learn more about activity based costing. Okay, so let's move ahead to the next question. That is, they have given us a few terms like net worth, contingency liability, opportunity cost, intangible asset and term loans, and we are asked to explain these terms as used in accounting. So let us look at these terms one by one. Okay, so what is net worth? An individual's net worth is simply the value that is left after subtracting all the liabilities from assets, right? So all the assets minus the liability is your net worth. So yeah, so that is net worth. Next is what is contingent liability. So a contingent liability is a liability that may occur depending upon the outcome of an uncertain future event. Okay, so this contingent liabilities, they can be recorded only if the contingency is likely, and the amount of liability also can be reasonably estimated. So such liabilities, they may be disclosed like in a footnote on financial statements and all, unless the conditions are not met. Next is opportunity cost. So opportunity cost is also known as actually alternate cost. Okay, so as a one liner, okay, you can think of it as the value of what you have to give up in order to choose something else. Okay, that is, it is the value of the road that you did not take. Okay, simply put, it is the value of the road not taken. Simple. So like for example, if after your 12th you were presented with two options, one was BTech and the other was maybe arts. So right now you might have chosen one of this. Naturally, after, if it was BTech or if it was arts, okay, or maybe BSc or whatever it is, going forward after like a few months into the course, you would definitely start thinking of how my life would have been if I had chosen the other option. We always think, right? We always think about what would have happened to us if we had chosen the road which we did not choose. Simply, that is your opportunity cost also. Okay, so that is opportunity cost. Next is intangible assets. So an intangible asset is an identifiable non-monetary asset without a physical substance, right? Intangible. It is an asset which is intangible. That is, it does not have a physical form. So such an asset is actually identifiable when it is separable or when it arises from a contractual or other legal rights. Okay. So that is intangible assets. Next is term loan. So what is term loan? A term loan is a lending arrangement which provides a borrower with a fixed sum of cash. In exchange, the borrower has to repay the loan via a fixed number of installment payments over a fixed term of the loan. So this type of loan is typically for periods longer than 1 year. Okay, like our housing finance loans, all these things, gold loan, they are all term loans. So that is it for this video. We have much more questions to discuss. I will discuss them in detail and upload videos shortly. I'm keeping the answers a bit more described for MMPC 4, especially because this is a little bit of a difficult topic for most of us, right? Especially people who are coming from the non-commerce background. These terms would be totally new to them. So that is why rather than just brushing the topics and leaving, I'm trying to explain to you as much as possible for each question so that you can revise the concepts as well. Therefore, what has happening is that since I had collected a lot of questions from at least around 5 or 6 term and examination, so we have a lot of questions to discuss. It is taking time, so please bear with me. And all the best, study well, concentrate on your strengths. Definitely look at your assignment question answers, at least your assignment question answers, including the mathematical problems, okay? Because there are chances that if you are lucky enough you would get the exact same problem as well, okay? So definitely do not go without studying the concepts that were asked in your assignments. Apart from that, this few things like accounting principles, gap, what actually is accounting, like what do you understand by accounting. Then what are the different books of accounts, golden rule of accounting, all those things, right? They are also important. The accounting concepts is actually very important. Either you will get a general question or you might get a short answer type question where you are asked to explain any two different accounting principles and or accounting concepts. So definitely do check that out. I will make another video to touch upon the important major concepts. Most of those concepts will already be discussing while we are discussing the important question answers, but still as a summary I will be uploading that as well, okay? So all the best, write well, see you in the next video, bye bye.